Welcome to Card Table Commentary. I'm your host, Seymour Peterson. In installment number 4, we looked at the performance of the economy in the 60s and 70s. At that time, some Keynesian measures had been implemented to try to stimulate the economy. But up to 1980, historical restraints still were very important in determining what the government thought they could do and not do. It was thought that too rapid increases in the money supply would result in inflation, that too big a federal deficit would result in higher long-term interest rates and a crowding out of more productive investments. And it was thought that a unfavorable foreign trade balance would adversely affect the value of the dollar. Actually, at the end of 1979, the federal debt held by the public was only $658 billion. Of that, $382 billion had been added in the 70s, which means that in the 24 years between the end of the Second World War and 1969, there was only $51 billion added to the federal debt held by the public. All these numbers are a mere pittance in comparison to modern numbers of the similar things. So up to 1980, fiscal stimulation really hadn't been used as an economic tool very much. Manipulation of the money supply and interest rates were the primary tools used up to 1980. In the fourth installment, we showed how the lack of discipline on the part of the Federal Reserve resulted in rampant inflation and poor economic performance for a whole decade. In 1979, President Carter appointed Paul Volcker as the new chairman of the Federal Reserve. Volcker proved to be the right man for the times. He resolutely increased interest rates and tightened the money supply until inflation started to ebb, and it took a long time. And he continued a tight money policy through most of the 80s. I can remember when I bought this house in 1986, the best interest rate I could get was 8.75% on a 15-year loan. In 1980, President Reagan was elected, and he was supportive of Paul Volcker, even though it resulted in a deep recession that lasted until 1982. But after inflation was slowed and economic confidence and especially investor confidence was restored, the economy grew at a above average rate for most of the rest of the 80s. Unfortunately, the 80 to 82 recession had eroded the tax base. At the same time, the president wanted to increase defense expenditures, and the result was that in the 80s, federal debt held by the public increased by $1,587,000, or almost 3 times what it had been at the start of the decade. Once again, these numbers are mere pittances compared with what we talk about in more modern times. But at the time, that represented a huge increase in federal borrowings, and it was the first real use of debt to help enhance economic performance. Volcker's actions to control inflation were the right medicine for the times, but it proved to be very painful. In August of 1987, Alan Greenspan was appointed as the new Federal Reserve Chairman to replace Paul Volcker. Greenspan was a monetarist, and he was a disciple of Milton Friedman. And monetarists believe that if the money supply was increased at the same rate that the economy was actually growing, that there would be not an inflation problem. Right away, after being appointed, his belief in his monetarist principles was tested when the stock market crashed in October of 1987. It went down 21% in one day and 31% over a 3-day period, and it shook confidence all over the place, especially in investment stuff. But it was big news. That was a huge decline in such a short time, and there was a fear that this was going to trigger a prolonged recession. And Greenspan responded by flooding the market with liquidity, making it easy for brokers that might have to honor trades that they were going to lose money on to be able to continue their business. And interest rates went down to almost nothing for a period of time. And it eventually repaired the damage to the economy and to the market. And within 2 years, the market was higher than it had been before that crash, and it continued its rise from really the bottoms in 1982. This represented an apparent violation of any monetarist principles. And so it appeared that it really didn't cause any inflation. A lot of money was added to the money supply in a short time. And yet inflation really didn't pick up. And I think that as a result of this experience, it emboldened Greenspan, who remained the Federal Reserve Chairman for many, many years, to undertake similar operations anytime a financial crisis occurred in the future. From this point on, Card Table Commentary is going to introduce a lot more statistics into what we talk about. And most of these will be presented in the form of a graph that will accompany my talking points here. The information for these graphs comes from the Federal Reserve Bank of St. Louis, which accumulates all kinds of statistics about the economy, and they're readily available for anybody for research purposes. And that's where these numbers come from. We're going to use the gross domestic product, or GDP, as a measure of economic performance. GDP is the production of goods and services in the U.S. over a period of time. For a measure of fiscal stimulus, the amount of money that the government injects into the economy, we're going to look at the change in the debt owned by the public between different dates. When you compare that measure with the budget deficit, which is sometimes used, you find that the budget deficit understates the amount of money that's we're borrowing by a significant amount. Over the 70 years from 1950 to 2020, it was at least $3.5 trillion less. The reason that there's such a difference between the deficit and the amount of money that the government has to borrow is that some budget programs, like the student loan program, are greatly different in the way they're accounted for the budget accounting and on a cash basis. The money goes out much quicker than would be shown in the budget accounting. At this point, we're going to introduce two graphs. One of them shows the debt owned by the public from 1950 to 2020. The other one shows the change in the debt by year over that same period. The figures are in trillions of dollars, but you can see that very little debt was added before 1980. In the 80s and 90s, it started to increase at a fairly slow rate, but then it took off after the year 2000. And the next installment of Card Table Commentary will talk about the 90s.